Welcome everyone. My name is Jimmy Singh, broker, owner with Fortune 2 Realty. I've been selling real estate for the past 20 years across southwestern Ontario, Greater Toronto area. And in this video, I like to share some of my thoughts I was putting together on the morning, how these cycles or real estate cycles work. Every downturn feels like this one will never end. Downturns are the chapters, they are not the whole book. But if you see Canada's property market historically, especially southwestern or Greater Toronto area market, it tells entirely a different story. Every decline in the past has eventually given to a recovery. Market moves in cycle. Fear is temporary, and before you make any decision based on today's headline, it is worth remembering that in the past 50 years, real estate is the biggest wealth creator for average families in Canada. It is the true tax shelter. When you buy your primary residence, you take leverage, you put 15-20% down, you live in the property for 10-15 years, and it has appreciated 4%, 5%, 6% roughly per annum, depending on which market in southwestern Ontario are we talking about. So it keeps up with inflation. You enjoy your property, and over the time you pay it off, and it is true tax shelter. When you retire, you want to move abroad or downsize, you can sell it, and that liquid is your retirement money. So that is number one thought. Another thing is people panic very quickly. For example, I was talking to one of my customers in the morning. Let's talk about last year tariff announcement from US in the whole world. Go check out S&P 500. That is the stock market index in US, where 500 of the biggest companies are trading there. And it shows you when they announced the tariff in April, there was a quick correction of 15-20%, but then the market bounced back within like a month or two to reach next all-time high. And if you Google today, which is June, which is the month of July, you can see right now stock market is again all-time high. Though we are fighting multiple wars in the world, there's tariffs, there's uncertainty. This is exactly what I want to do, convey the message to my customers. Zoom out. If you want to see how the prices have done in Greater Toronto area, go check out the map or the graph for last 30 years. You will see, yes, prices can remain flat for next few years, but if you see the kind of properties being built in the market, if you see in the last 4 or 5 years, the focus of new build is purely rental apartment buildings. And if you see the single family homes, they are declining. Builders are not making those ones because of the uncertainty in the economy. So what do you think is going to happen 3, 4, 5 years from the down? You will see again the same kind of things. Hundreds of thousands of people are coming to Canada. Immigration will never stop. And you will see people want to live in good cities where there's good infrastructure, job opportunities, and are affordable. So that is first thought I want to share. Another one is everyone talks about house prices. Very few people focus on transaction volume. Transaction volume tells you the mood in the market. Volume tells how many people are buying and selling. So if you see past couple of months data from January, February all the way to June data, you will see transaction volumes have picked up. The reason is if an average family qualify for 600,000 mortgage and the houses have corrected in that market and touch 600 range, many people will jump into it. Yes, mortgage rates are higher than pandemic, but pandemic rates were anomaly. They are not coming back. Historically, Canada's mortgage rate always hover around 4%. If you can get into mid 3% today, that's a really good deal on the mortgages. Another thought is everyone wants change. They want to make housing affordable, but here is the thought. Who will pay the price? The risk right now is creating negative equity for lot of first time buyers. And I was doing some calculations and reading some reports from economists. They said prices in Greater Toronto area have to decline 30 to 40% for the affordability to improve in any meaningful way. Do you think that kind of correction banks want it, builders want it, existing homeowners want it, first time buyers want it? Negative equity affects lot of real families. Those are teachers, plumbers, doctors, small business owners, and this negative equity hurts. Lot of first time buyers who bought in suburbs of GTA with minimal 5 to 10% down, and since they have negative equity, meaning prices have come down 20 to 29% in certain markets, now those people are hurting. So there's real issues in that thinking. We want affordability, but we don't want to hurt the first time buyers. How it is, it doesn't even make any sense to me. Like, we want affordability, but government haven't done much in last 15 years of housing. To make a house, land prices prohibitive, the development charges, levies are expensive, and now they're coming to realization, and now they're hurting even the investors, which are normal people buying properties for their kids or buying in close to university area where there was demand from the students to cater to our growing rental needs since the population have exploded. Now, I have a simple question. Why do you think people buy property? So people buy property because they want to see future growth. Nobody buy real estate because of the tax deductions or $200, $300 cash flow every month. They believe it will be worth more tomorrow than it is today. And some economists were saying the prices might stay flat for next 3 to 5 years, which they could, but Canada's biggest problem remains unchanged. We are still bringing lot many people into the country, but we are building less houses. And until that equation changes, the long-term pressure on property prices remains the same. So that is the main thing. Property prices are not just falling because of the interest rate, they are resetting because after the fastest and biggest boom in Canadian housing market in past 15 years, where prices ran ahead of wages and affordabilities. Now, if wages are not doubling, affordability requires lower home prices. The problem is most Canadians, including the retirees, have large chunk of their retirement in their houses. So who will pay the actual price if the property people want them to crash 30-40%? The teachers, the nurses, the plumbers, the normal folks who work honestly hard all their life just to have a house for them and their family. So when government change rules and regulations overnight, it has consequences. Activity slows down, and suddenly investors and all those people, they start looking for different options to invest somewhere else. And home buyers hesitate. And these things have consequences. I meet lot of young families who want to buy a house. They are not scared to buy. The only thing is they are scared to buy the wrong kind of property or in the wrong kind of market or paying over price, so it might hurt in the future. So negative equity is the biggest challenge I see. People who bought 3-4 years ago, they put minimum down payment, and since the house prices are down, they're kind of stuck. But if you have long-term plan, keeping your property for 10, 15, 20 years, you can afford the cash flow, you will do fine. So the key question isn't when the price is going to go up this year or next year. It is, can I comfortably hold long enough to overcome or ride this cycle? This is very critical question you have to ask if you're buying real estate is, in this cycle, if I buy real estate, can I survive this cycle? These cycles can last 5 to 10 years. So I hope you like my video. Share your thoughts at the bottom. My name is Jimmy Singh, broker owner, Fortune 2